Carl Kaufman, you think that central bank stimulus programs have taken us as far as we can go. So what does that mean for bond investors?
I think what it means is that we may still have some room to go if they go helicopter money, but we're in the 10th inning here. So I think returns are going to be low for sovereign investors and investment grade investors, but there's still some room on the high yield side.
And over 80% of your portfolio is in short duration high yield. How are you selecting those securities?
Well, at Osterweis Strategic Income Fund, what we do is we research every name from a bottoms up. We don't have as many names as a fund our size. We have about 77 portfolio companies, and we research them like an equity analyst would, just getting to know managements. And we always buy them with the intent to hold them to maturity if we have to. So we do the work on the front end so we don't have to do it on the back end.
And energy and materials, when it comes to high yield, they really took the market down last year. They've brought it back up this year. What's your exposure to these sectors?
We have decimals of exposure to those sectors right now. So they helped us last year. They didn't help us this year. But I think going forward, they're not going to be much help. They pretty much recouped their losses.
All right, so which sectors are going to help you in this particular area of the curve?
I think it's companies that can survive in a low growth environment, that provide services and products that people use every day. And because people go on with their lives, despite the fact that we have predicted financial collapse and calamity for the world's supposed to have come to an end 7 times in the last 30 years, and it hasn't. So,
and what kind of yield are you looking for? Because right now a lot of people, they worry about stretching for a yield, especially in the high yield sector, because they got burned last year by energy. So what do you pinpoint for a yield that you'll accept?
That's right, and it's different, it's situational, but as you can see by my body, I don't stretch much, and that's how you get hurt. So every situation is different. In some cases, a 3% yield for 2 months is fine. In other cases, a 5% yield for 3 years is fine, depending on the company. But we'll take what the market gives us and analyze, where the risk reward, if we can get an asymmetric risk reward, we'll take it.
And over 10% of your fund is in cash right now. You say cash is king. How and when do you put that cash to use?
We use cash as a tactical asset. We don't mind letting cash grow when the markets are strong like this. And we wait for price weakness. We like to buy, it sounds corny, but buy low, sell high is how you make money. And we wait for the market to crash, and then there's lots of stuff for sale at good value, and that's when we put the cash to work.
And do you see that crash forthcoming?
It's on Wednesday, I just don't know the month. I think sometime around the election you'll see some more market volatility. The central banks seem to be full steam ahead to try to float markets, and so we're raising cash in this environment.
All right, and then finally, another area that you're looking at but you really haven't taken a bite out of yet is convertible bonds. I guess you want to get paid to wait. So why is this area of the bond market attractive to you?
It's attractive because of the optionality. If you can get a free call on a company's future prospects, if you can buy those bonds at a yield that is similar to a non-convertible bond, then it's a win-win. So we're waiting for stock market weakness. We did buy some in the February correction. We're looking to buy more on equity weakness. We've got a list ready to go, and just need the market to cooperate.
All right, well, thanks a lot, Carl.
Thank you very much.
Thank you for watching The Street.